Second only to trade credit, bank credit is used by many companies to finance short-term activities. The bank loans, typically banks want to make loans that are self-liquidating, and what we mean by self-liquidating is that the use of the funds ensures a built-in or automatic repayment scheme. So for example, a bank may lend money to a company to purchase inventory. That inventory will subsequently be sold. As the inventory is sold, cash comes in, and that cash can be used to pay off the bank loan. So in that sense, it's self-liquidating. The loan is for the inventory. The sales of the inventory are used to pay off the loan. Now, in general, bank debt is short-term. However, from time to time, or it's not uncommon really, banks will make short-term loans, but they'll roll over those short-term loans every 60 or 90 days. Essentially, the idea here is that the bank is continuously monitoring the quality of the company, making sure there aren't any changes to the financial condition, and as long as things haven't changed at the borrower corporation, the bank is willing to extend the credit on more or less the same terms that it has extended credit in the past, although of course interest rates will change periodically to reflect whatever the market conditions are. Let's look at a few terms that are used in describing the terms of bank loans. The first one is the prime rate. The prime rate is the rate that a bank charges to its most creditworthy customers. And for the most part, this is true. Having said that, when the market is particularly competitive or for very, very high quality firms, banks might occasionally charge actually less than the prime rate to some of their best customers. Having said that, the prime rate is a rate that there's historical data on that's collected. As a general rule, companies are going to pay 2 or 3% above the prime rate. Most companies will pay that, whereas extremely high credit quality companies will pay the prime rate or even possibly a little bit less. In a sense, the prime rate is just a benchmark. Now, there's another benchmark that's frequently used called the London Interbank Offer Rate, or LIBOR. LIBOR is a rate that is available principally to banks, as the term implies, London Interbank Offer Rate, but it's available to companies that, first of all, they have to have an international presence, but it's an interest rate that is pegged to the dollar. It may surprise you to know that you can go into a bank in London and borrow in dollars. You can actually borrow dollars, even though the dollar is not the official currency of the UK. The dollar is sort of ubiquitous. It's used all over the world, and you can borrow from banks all over the world dollars and pay interest in dollars. However, LIBOR is the rate that's available to these, for the most part, large international companies, although that rate is used to peg other financial instruments. So, for example, adjustable rate mortgages are frequently tied to LIBOR plus 1% or something like that. So it's an interest rate like the prime rate. It's very similar in that regard. It's basically used as a benchmark. Here's a graph showing how the LIBOR rate and the prime rate have tracked over time, and you'll see that the prime rate moves around in little discrete jumps because it is a stated rate that the banks are offering loans to the best customers for. It's a stated rate, whereas LIBOR is a market. It's a rate that's generated by the market literally on a daily basis. Actually, even more often than that, minute by minute. But you can see that on the whole these track very, very closely. The LIBOR rate and the prime rate track very closely. The prime rate is a little above the LIBOR rate. A second term that's of interest to us is, I guess we've had two terms so far, the prime rate and the LIBOR rate, but a second idea is compensating balances. And a compensating balance is an average minimum account balance that has to be maintained by a company at the bank as an alternative to paying the bank fees for services. So rather than paying $100 for banking services, a company might, through a compensating balance, leave $20,000 on deposit at the bank that it cannot withdraw. So really this is just in a sense a bartering arrangement. I will loan you money at 0% interest and you will provide services to me at no cost. Obviously there really is a cost. It's the cost of the foregone interest. When interest rates are lower, compensating balances are higher because frankly the bank's use of the money is less valuable when interest rates are very low. So what the bank is giving up, or what the customer is getting in terms of services, is more valuable relative to what the bank is getting in terms of, say, free money, because that free money just can't earn as high a return. So when interest rates are lower, these compensating balances need to be higher. Now the required amount of a compensating balance, the required account balance, is typically computed as either percentage of the customer loans outstanding or a percentage of bank commitments toward future loans. So the customer might have borrowed $10,000 and the compensating balance may be based on that, or the bank may have extended a line of credit that says you can borrow in the future up to $100,000, in which case a compensating balance may be based upon the amount that may be borrowed at some point in the future, based upon what the bank's commitment has been to that point. Continuing on a little bit, let's look at what the amount of that compensating balance might need to be. If the amount that needs to be borrowed, well, let me just read this. The amount that must be borrowed is calculated by taking the needed funds and dividing by 1 minus C, where C is the compensating balance expressed in a decimal. So, for example, and this is just mathematically, the amount borrowed is equal to the amount needed divided by 1 minus C. So if we have $100,000 that's needed, and we had a 20% compensating balance, so this is our 20% compensating balance, then the total amount that we would need to borrow would be $125,000, which is, of course, 100,000 divided by 1 minus 0.02, or 100,000 divided by 0.8 is 125,000. Let me clean up a little. Okay, so that discusses what a compensating balance is. Another area that we need to be familiar with is where bank loans are actually not particularly short-term, but are extended over longer periods of time. And so, for example, with a term loan, credit might be extended for, say, 1 to 7 years. That's not short-term financing, that's longer term. And the loan is usually repaid on a monthly or quarterly basis. Now, not every company can obtain loans of this sort. As a general rule, they need to have high credit quality. And the interest rate frequently will fluctuate with market conditions. The banks don't want to lend money for long periods of time at fixed rates, not for very long periods of time. If there's concern about rates fluctuating, so in many cases some of these loans may have a fluctuating rate themselves that is tied to the prime rate or the LIBOR rate. So what this means is the interest rate they're paying is based on a short-term rate, even though the commitment that they have is for a longer period of time. Let's talk about how the cost of various bank loans is calculated. The effective interest rate on a loan, this is just a standard loan, is going to be based on the amount that's borrowed, the amount of interest that's paid in dollar terms, how long the loan exists, and then the method of repayment. So if we're looking at a loan that's repaid in one amount, the effective interest rate is equal to the interest amount, and this is a dollar amount right here. The interest amount's a dollar amount divided by the principal, which is also in dollars, multiplied by the days in the year divided by the days the loan is outstanding. Now, in addition to that standard loan, we also have what are referred to as discounted loans, where instead of paying the interest at the end of the period, we pay the interest on the front end. So you borrow $100,000, pay $8,000 up front if it's 8% discounted loan, but our effective rate is changed, and this is the formula for the effective rate. It's really, in essence, the formula that's exactly the same as the previous one, except notice here that we don't get the whole principal. We only get the principal less the interest amount on the front end, so that changes the calculation of the effective rate. All right. Now, we talked about a compensating balance, and what happens to our interest rate when we have compensating balances, or what's the effective rate in that scenario? Well, let's assume that 6% is the stated annual rate and that there's a 20% compensating balance required. The interest rate clearly, the effective rate clearly is higher than 6% because we're not getting all the money. We're paying 6% interest on the entire loan, but we don't get to keep the entire loan. So how much do we keep? Well, we keep 1 minus the compensating balance. So our effective rate is the interest divided by the portion of the loan that we get to keep. If we had a 20% compensating balance, we have to keep 20% at the bank. That means we only actually get 80% of the loan proceeds. We're paying interest on 100%, but we only get 80%. And so this little formula that we have right here, interest over the interest percent, so this is in percentage, divided by 1 minus the compensating balance, gives us the effective rate. All right, if we didn't know the interest rate, but we had some dollar amount that we knew was the amount of interest being charged, we've got another little formula, and that's here at the bottom. We see here where the effective rate is equal to the compensating, the effective rate with the compensating balance. In this instance, our interest amount is in dollars. Our principal, of course, is in dollars, and our compensating balance is in dollars. If the interest is in dollars, then our compensating balance has to be in dollars as well. And then that's just multiplied by the number of days in the year divided by the days that the loan is going to be outstanding. If we have an installment loan, installment loans require a series of equal payments over the life of the loan, and the effective rate on an installment loan is approximately or almost double what the quoted rate of interest is. In essence, and the reason is because toward the end of the loan we have almost nothing borrowed, but at the beginning the entire amount's borrowed. So on average we get about half of the stated amount of the loan during the course of the loan period, and so we have a little formula here that equates the effective rate on the loan to the stated interest rate, or the stated interest in dollars that we have. So if we were to borrow, for example, $1,000, and we paid interest on this, total interest of $60. Let's imagine that this was over a 1-year period, so our total number of payments was 12. And this 2, of course, we just multiply by that. The total number of payments that we have, again, here is 12 plus 1 is the portion in the brackets down here. What would the effective rate be? Well, if we went through the math there, 2 times 12 times 60 divided by 13 times 1,000, we would get an interest rate, effective rate, of about 11.08%. So we have looked now at a number of mechanisms for different types of loans for calculating the cost of bank financing and the interest cost without compensating balances, or with compensating balances, or with installment loans. And there are a lot of different types of loans a lot of different alternatives that might be used. Let's take a moment though to discuss the idea of a credit crunch, and this became particularly important in 2007, 2008, but there have been credit crunches that have occurred over the last 50 years on a half dozen occasions. And basically a credit crunch occurs when banks significantly tighten the availability of credit. So companies that thought they had were going to be able to roll over a loan find that the bank believes circumstances have changed and the availability of credit becomes much more difficult. What causes that? Well, if there are a lot of unexpected defaults, banks will recognize, oh, risks are much greater than we thought they were. We need to be much more careful about who we loan to, and we need to cut off credit to some of our customers. That's likely to happen during an economic recession. In addition, from time to time, the Federal Reserve will change what's referred to as monetary policy. Basically, they raise interest rates in an effort to discourage banks from lending as much money. Why would they do that? Typically because they're concerned about inflation. They want to reduce the economic activity. The mechanism for doing that is make it harder for companies to borrow money by raising the cost of money to banks. And there may be other economic setbacks. In 2007, 2008, there was a great deal of concern about the actual solvency of banks, and banks became very concerned that they may have a run on the bank. In other words, their depositors might want their money back in a hurry, and if you have the depositors' money loaned out, which is what banks typically do, if the money is loaned out, that cash isn't available to repay the depositors immediately. So when there's a fear that depositors might run for the exits, the bank has to be very, very careful about who it would grant credit to, because it needs to have the cash on hand. So there were the potential for bank runs, various bank failures in the late 2000 era, and it led to a credit crunch. Now what we've gone through is basically a summary of the various types of credit that is available for commercial purposes from banks. Certainly not all of them. It hasn't been exhaustive. But after trade credit, banks are for most companies the next source of capital that firms are going to use. In the next section we'll take a look at the use of commercial paper.